Good morning. We are here today with Edward Kliphuis, who is a partner at Amadeus Capital Partners, based out of Madrid. He will be a panelist on the Barcelona Health Hub Summit's panel on digital therapeutics. So welcome and thank you for joining us.
Thank you for having me.
So the move to Amadeus is relatively recent, is that correct? And can you tell us about that?
Yeah, I guess the announcement is relatively recent. The move has been in the works for a while.
Okay.
It's really the culmination of about 2.5 years of discussing with the guys at Amadeus. Maybe in a nutshell, we identified really an opportunity at the early growth, so the scale-up stage, for what we call deep tech investments in Europe. Really driven by a fantastic amount of innovation coming out of European universities, an abundance of talent in Europe, and really a thriving early stage venture capital ecosystem. But then there's nobody really to pick up that pan-European check that allows these companies to scale to true growth investment. And so that's the opportunity we want to capture here, and particularly also in health tech.
And how does the deep tech differentiate from frontier tech?
I would say frontier tech is a subclass of deep tech. So the way that we define it, I mean, these are a bit fluid, right? But the way that we define it is that deep tech is really any innovation that sort of like is driven by scientific or engineering progress. And so any product developed by these engineering and science innovations could be a deep tech innovation. And therefore frontier tech usually finds itself more on the, let's say, on the fringes of it, like satellites, perhaps even new ways of growing meat, whereas deep tech can also even classify things like biotech. It's important to state that with the fund that we're now raising at Amadeus, we're not going to tackle biotech. We're really limiting ourselves to what we call bits and atoms. And
at what stage do you guys participate? Are you seed or Series A or later?
So Amadeus has got a number of different strategies. Amadeus is investing in seed stages from its early stage fund. So that's really doing seed and Series A. The fund that we're now looking to deploy from is looking really at product market fit stage. So that's pretty much, I would say, commercial traction needs to be there, or at least we need to have a de-risking of the science and a de-risking of the technology, meaning that the risk we want to assume and that we model the strategy on is really the scaling risk of any technology.
I noticed on your website that besides speaking at the Barcelona Health Hub on October 29th, see, I got the plug-in. That's my job. Beyond that, you're speaking at Frontiers Health and you're speaking at some other conferences. So how does that feel these days compared to the days when we were all standing in a room together? What's the conference experience like for you?
It's really, really, really different.
Are you laughing at my plug, or you're like, you know?
I'm laughing at all of it because I thought it was a brilliant plug. Very well done. But what was the date again? The 29th, right?
Yeah, very subtle, right? Yeah.
No, I find it very, you know, it's the same with all these meetings. You're just sitting behind your desk and having all these different panels and everything. But what I miss is really the interaction with the audience. There's kind of a tension when when you're doing a keynote, when you're coming on stage. There's kind of a good sort of tension, and then of course having the ability afterwards to meet people, like that whole networking thing is completely cut out of the equation. And so the sort of like systems play that I like about conferences, that's sort of been reduced to just pumping information out into a recipient group which you don't even get to see or get to engage with that directly. So it's different. Hopefully it won't be forever, but I'm happy that at least we can make it, we can have some continuity in this format.
And then how does that then roll over to, meeting new investment opportunities and the startup community? What kind of impact does that have, with this taken away?
I think it's the same, right? I mean, if we're truly honest, the amount of investments that we do, there's a number of different sources. I mean, we have the outbound, so that's basically us reaching out to companies saying we would like to have more information on your venture and on your technology. Then there's inbound, which is people approaching us, and then there's a lot of thesis-driven investment that we like to do. where we basically build a thesis around a certain area. We did, for example, biosensing and biointerfaces, which is, I think, relevant to the panel I'm going to be on. And then that allows us to pattern match opportunities that come in, and allows us to also reach out to opportunities to see whether, you know, there's an investment potential there. So how does that relate in the current environment? I guess part of that is still the same. It's just that the inbound is much more, the hurdle seems to be higher for people, and the signal to noise ratio is unfavorable at the moment. Normally, due to conferences, we get to present as investors what we look at, and therefore people who believe that they're fitting that profile can come up to us. I guess nowadays we're getting all kinds of outreaches from, I don't know, like real estate investment opportunities all the way to actual venture capital solutions that might fit our profile.
You know, and you know, we're told that, you know, cold calling a VC just doesn't work, right? And so can you speak to that? You know, this idea of this inbound, they're just soliciting you. I mean, how many deals have you actually done from sort of an, you know, an unintroduced inbound reach?
Let me take that in two stages. Let me first answer the first bit of your question.
Okay.
I think contacting VCs is always a good idea, but I think it needs to be understood that venture capital is not an end goal. We're just another tool in let's say, the shed of tools or solutions for startups to grow. So I think, and I always advise this to founders, like, as a founder, you need to, I think, be introspective around, okay, what are the tools that I need to grow my business? And acknowledge that venture capital is essentially rocket fuel. If we invest, we are quite demanding around the growth that we need to see, which is really a function of the model that we work from, because the investors that give us the money ask us to really have these companies that we invest in outperform. And some of them will go bust. So as a consequence, some of them have to outperform drastically to offset for those losses to make sure that our portfolio still returns. So if the venture, for example, doesn't fit that profile, let's say you have a particular kind of wearable, you have a steady cash flow, but you won't grow 3-4 times year on year, then maybe debt financing is good enough. Get a bank loan. You don't need to have some annoying venture capitalist on your board. But if you do feel that there is a need for getting venture capital in and allowing you to scale to or ramp up in a certain velocity, then I think it is definitely advisable you know, to reach out to a couple of friends, understand what these particular individuals are doing, and you know, which ones probably to reach out to as a first step. The way that I work, I like to at least always be in a dialogue with founders. I believe that, you know, we are just fulfilling another role in the ecosystem of a startup creation. So rather than just doing the Tinder thing where we say swipe left, swipe right, and if you don't fit our profile, you never hear from us again. We kind of like to engage in a dialogue and send people the right way, even if it's not for us for an investment, because we believe in, you know, people coming back in the ecosystem, potentially having their network refer to us. So by doing good, we receive good. But that said, there is on a particular cold outreach, I don't think we ever invested on the first go. But we have, for example, from cold outreaches, worked with the founders for over 2.5 years, and then finally invested. So it's a longer term relationship.
And when you're looking at technologies, and this may not apply if you're getting a little bit later, but especially if you look at like the early stage, how important is, you know, is it team or is it technology or is it a combination? You know, what are you looking at there?
So I won't speak for all of Amadeus, because I think there's different strategies at different stages.
Sure.
For what I'm looking at, we really look at product market fit, and that really comes back down to 4 different categories. So we do assess team. I think team is very important in this instance, in particular at the scale-up stage, because in the early stages, you'll oftentimes find sort of the lone wolf founder who aggregates all the information in his or her domain and is used to controlling the fate of the venture A to Z. Now, if you think about scaling an organization, unfortunately, that can no longer be the case. So we see oftentimes a growth slump at that stage, where you sort of like have to instill this organizational discipline with different subdomains, like a chief business officer, chief financial officer, a chief product officer. And so that actually is very important for us to assess how that particular step has been made or how it will be made. Then the second one for me is really the product readiness. Is there any technical risk in this product still or not? If so, how much can we quantify it? What are the solutions to mitigate that risk? Or have there been already market validation steps taken? So do we have some proof of concept revenues that we can deduce that the product is ready to scale? And then, is the organization ready with, let's say, market ready KPIs? Is there a reporting system in place? Do we understand, how particular, let's say, SQL, MQL feedbacks actually feed into that particular revenue funnel? Why is there attrition, and how does that really turn into, money at the top of the funnel? And lastly, it is really the go-to-market strategy. Like, is the go-to-market strategy sound? Do we believe that the company is attempting to diversify its client base, and is there potential for that? Because oftentimes having a very concentrated client base could be very detrimental for the future of a business. So we're somewhat later stage, and we really look at these things in let's say, equal weighting. And
to jump back to the first part, to focus back on sort of the team or the entrepreneur, are you looking for a serial entrepreneur, or how do you, assuming they're not a serial entrepreneur, how do you validate sort of this experience if this is the first time they're doing it?
It's hard, right? I mean, look, I've been down this path. Like, I'm sitting in front of other investors asking them to entrust me with money, and I did that, as well for somebody who hasn't been, when I first started, particularly long in the industry. So I've been down this road myself, and I know how incredibly tough it can be that people say, well, there's no history to point back to, so why should we trust you? So I think we do pride ourselves on, working with first-time entrepreneurs, trying to understand what drives them, and really doing diligence on the individuals, and doing diligence on the surrounding team. But yeah, that is definitely, especially for first-time entrepreneurs, a bit of a black box, and something where just over a number of dialogues, you have to find out what really drives the individuals. And Zoom is not really helping with that.
I mean, is your role at that point to fill in the knowledge gaps for them?
Yes and no. See, I want to be cautious not to come across arrogant, because I think there's two different profiles. Well, you said there was going to be a friendly interview, right?
Yeah, well, hey, I'm being nice. Believe me, I'm being nice.
No, I think there's different roles to fulfill. Like, we're specialized generalists, right? So we see a lot of information, but we don't perhaps have the deep sector knowledge that the founders will have. And so it is really a partnership. If we do this well, it's a partnership. It's a partnership where the founders will have the domain expertise and really the depth of knowledge in their particular domain to an extent that we probably can never possess, because we don't have the volume of time to spend in that subdomain. So there's a level of trust needed there. And equally, there's a level of trust needed on, let's say, a higher level, where, we will speak with more investors at a different dialogue. We'll speak with more opportunities and have a different dialogue. And so aggregating that information and matching the two can be a very good and powerful combination. So filling knowledge gaps, I think that's a two-way street, because equally knowledge gaps will be filled by the founders to us.
So maybe to shift the conversation just a little bit, since you're going to be speaking about digital therapeutics on the panel, can you sort of help us and define digital therapeutics? Because we've seen different definitions on your website.
Yeah, it's a tough one, right? For me personally, it really is a digital intervention that has the ability to improve patient outcomes. That's it, but quantifiably so. And there is a discussion ongoing whether that should be regulated or not. I personally think that that's it really depends on the business model. But if there's no quantifiable improvement in patient outcomes, I think then the proposition becomes challenging, because that's really what it hinges on. If you catch my drift.
And what have you seen as far as, what reaction do you have when, somebody shows you yet another diabetes app?
I mean, what are the barriers to
trying to say
entry?
this nicely. Good job. Good job. Be nice. Yeah.
It's again, it comes back to what I said earlier in the interview. I mean, there's no wrong proposition. If that's a good business for you, then that's a good business for you, but it might not be a good business for a VC. And I think that's something which should be assessed. Just to give you an idea, like if you're investing from, I don't know, 100 million fund and you're looking to make anywhere between 10 and 20 investments, then you're looking for at least one or two of these companies to return the fund. That means if you as a VC own 10% of the company, that means that one of these companies has to be a unicorn. That means that in order to be a unicorn, we see a lot of healthcare technology companies trading between 8 to 12 times revenues. So let's take 10 times just for easy math. That means you got to have 100 million in revenues. Is that going to be possible in the time frame of 6-7 years? That's sort of the back of the envelope math that a lot of my peers will do. And the question then is, if you slice it by, let's say, unit economics of individual users and churn, you'll probably come to the conclusion that is not possible. And if that's not possible, then you probably either have, you're looking for a dialogue with a different type of investor, which again, there's investors with smaller funds that therefore require less of blowout returns, or you're looking for different types of financing, which again, there's no wrong answer. It's just that, different models seek different solutions.
Yeah, I mean, there's another investor that we've chatted with, and their sort of response is, for us, if the opportunity doesn't have $1 billion in the valuation down the road, it's not for us, right? And that's sort of their quick behind envelope, back of the envelope type of thing. And what do you think? What is the biggest misconception do you think entrepreneurs have when they're approaching a VC?
I don't know. They were an arrogant bunch. I think European venture capital still sits a little bit behind in perception to the US venture capital scene, although that seems to be catching up now. I think back in the day, we were definitely seen as old men in cheap suits. Okay. Hopefully that is changing a little bit, but it's now hopefully more an industry of peers. And as I said before, the way that we like to see it is as a partnership and as an ability to help each other further, but with vastly different responsibilities. So I think the misconception is that we just dish out money sort of without any strings attached, whereas, we also have to pitch for our money. So we know what it is to pitch. We also have to sell, and we also have an obligation to return that money. So we're kind of just in the same actions, just in a different part of the industry.
So I have a perception about European venture capitalists. Do you want to hear it?
Go for it. I hope it's good.
Yeah, it is what it is, and you can tell me why I'm wrong. But my perception is that if you compare them to the U.S. counterparts, they're just more conservative, right? That they need companies to be much further along and are probably more risk adverse than are the counterparts in the U.S. So,
you want to know why that is?
Sorry?
You want to know why that is?
So I'm right.
But it's because of a systemic issue. Okay. And there's actually two major issues here. And I don't know how this will be solved. So the first one is called hurdle rate. For historical reasons, European VCs have got a hurdle rate, which means that over money deployed, there is let's say an interest rate that is compounding, and only after the interest rate is achieved will there actually be carried interest. So one of the biggest fallacies for European venture capital is that a lot of these funds actually are in carry, which is why a lot of my peers in the industry will probably, rather than optimize for outperformance, optimize for downside protection. That's a different thing. In the US, this is not the case. In the US, for historical reasons, there's hardly any funds that have hurdle rate. Now, let me quickly explain what that is. Hurdle rate means if a US fund raises 100 million, the moment that they raise more than 100 million, that 100 million gets divided for carried and no carried for the managers. In Europe, oftentimes they put like a 6 to 8% hurdle rate on it. That starts compounding from the moment of investing. So if you do the back of the envelope math, you probably have to return 200 million before you ever see the first carry check. And so that's one of the drivers of behavior. The second driver of behavior is that Europe is still, it's a fragmented universe. So a lot of these venture funds take on money from local state affiliated entities, which the venture scene wouldn't exist without these local backers. But the challenge is that these local backers oftentimes oblige the managers to invest a proportion of their fund as a consequence into their home market. And so you'll see a lot of local VCs obliged to back entities in their home market rather than backing, let's say, the best asset. And that really means that, you're sort of like caught in a conundrum, in a catch-22 situation where you can't invest, let's say, in that one great startup that you founded in Latvia, because sadly enough, you have to fill your quota of deals in, I don't know, Belgium. And therefore you're backing up, you're ending up backing a mediocre entity, perhaps in Belgium, just to fill your quota to be able to go back to your LPs for raising the next fund. And then secondly, that means that you don't necessarily have the ability to outperform because of the hurdle rate. So yeah, it is true. I think it's changing now, though. I have to say, it is changing.
And then I guess my next question would be that another perception that I have is, and again, hopefully I'm wrong, but you can tell me otherwise, is that the venture capitalists have an expectation, because Europe is such a fragmented market, that, in order for you to, command the valuation that we talked about earlier, you have to go to the US. So there has to be somewhere in the timeline, the fact that the company will, go to market in the US. Is that consistent with what you see, or am I wrong?
I think it is no longer the case necessarily. I mean, we just did an analysis at Amadeus, and you'll see the amount of unicorns and the amount of companies reaching, let's say, a point of gravity that is adequate, growing steadily. And my personal prediction is that will only increase because of geopolitical tensions in the world. A major driver for this is the CFIUS regulation in the US, Committee for Foreign Investments into the US. They're nothing short of barring investments from foreign entities, which is China, Middle East, and Europe alike, into US startups, especially that have to do with particular, let's say, individual data. Grindr was an example of this. Veritas, as a genome sequencing play, was an example of this. And TikTok is now, of course, falling prey to this. So as a result, we're seeing at least a lot of Chinese interest in Europe, a lot of Chinese interest in the UK, and a lot of Middle Eastern interest. So with an influx of capital, there's definitely, a prediction to be made that, therefore, the ability to create blowout companies in Europe is only ever increasing. And we see it as well, by the way, with US VCs looking to add talent in Europe at this point.
But there's a challenge, right? Because you would acknowledge that it's harder to scale up in Europe because of the different languages, the different, regulations, 28 member states. How do you overcome those challenges when you're trying to scale?
Well, that should be offset, in my opinion, by almost 4 times the population sizes in the US. I mean, the European continent, depending on where you draw the line, but we have approximately 1 billion people. That's at least 3 times as much as the US. So yes, there might be some more hurdles, but the prize is also bigger if you do it right.
And let's go back to healthcare and health tech. So what's exciting you these days? What is on the horizon that you think is just going to be great?
Anything that has the ability to shorten the delayed feedback loop. The biggest threat to humanity in my thesis is delayed feedback. And so bringing the point of diagnosis quicker to the point of onset, bringing the point of intervention quicker to the point, close to the point of need, bringing the adequate or accurate medication closer to the point of need, that's all very exciting to me.
And doesn't a lot of that stem around the lack of interoperability?
Interoperability of what?
So healthcare systems just not having the systems to talk to one another. So, I was recently at a hospital in Berlin, and it's a very big, hospital, famous hospital that I won't name, but they have 49 disparate data systems. So when you request information from department to department, somebody manually walks over a paper file.
Yeah. And now we're getting philosophical, right? Because this is so. I changed my interest. So I came into this industry thinking that true change happens let's say, inside out. And what I mean by that is indeed from the health system, from the information system out to the constituents. I've come to reverse that notion. I've come to reverse that very simply because having lived in different countries, having consumed different healthcare systems, I see as an individual with a choice how I gravitate towards a health system or a healthcare provider that allows me that additional point of information. As a Dutchman, so I'll give you an example. The Netherlands is a very democratic healthcare system. Everybody's equal. There's one size fits all. There's no private healthcare insurance system. So, you call up the doctor, and whether you have this plan or that plan, you're basically being served equally in line. That's fantastic in its philosophy, but it is in practice sometimes a little bit challenging because it also means that there's very little competition for different hospitals to really serve their patients. Which means that a lot of these things are very entrenched. Now I live in Spain. Spain is pretty much like capitalist, like a German model. There's a private healthcare insurance and let's say a more public plan here. And so there's a high competition ongoing for the higher paying private insured lives. And the level of service as a privately insured individual that you get is therefore much higher. And so that pool is actually creating certain improvements in the system that then reverberate down into the rest of the healthcare system. I'll tell you what I mean. If I go to a place here called Quirón Salud, I download my app, I see all my x-rays, I see all my this, that, and I see my medical history. I go to another physician, I show him the app, he quickly downloads all the information, and he knows exactly what's been going on, which is helpful for me because, I'm trying to learn Spanish, but I'm not necessarily fluent to explain all the stuff that went on in my life. He gets to see that in a snapshot. In the Netherlands, I have no idea how to do that. So yes, I agree with you that a lot of this has to be done and is limited by the fragmentation of the system. And so therefore the only common denominator, at least in my philosophy, are the patients. So you have to change this from the grassroots. And only then will you be able to instill that change into the health systems. That's the sad reality, I think, for Europe.
And do you think that healthcare organizations are capable of that?
See, that's the question. They have to at some point. I mean, people have to vote with their feet at some point, and it will be hard because the fringe players, perhaps like you or I, who live in different countries, we have tasted this choice first. If you just grow up as a Spaniard in Spain, you kind of don't know about this so much, or you haven't experienced the differences, and you kind of take things as they are. So then it has to really be, we see a couple of macro trends in my philosophy that at least will accelerate this change. The change in demographic pyramid will mean that insurance companies and payers have to change their model, which means that there's going to be more scrutiny on lowering cost and improving outcomes, basically keeping people healthy for longer, prevention, and therefore, having
value-based
less
care.
of. That's right.
Yeah.
And that will change, in my opinion, to the individuals with the premiums they pay. Therefore, there will be almost a grassroots-driven change by individuals voting with their wallet for the places where they have to pay less and get perhaps better care or get better access, and that will instill that change. That's my personal philosophy.
Okay.
But
and I guess my response to that is that, my question, I guess, is, this concern of whether or not healthcare organizations can do this, because alternatively, what I'm seeing is, 5 big tech companies are going to run healthcare in the future, right? And that my doctor will be Google and my pharmacist will be Amazon, because they have the capabilities to put things into the cloud, to have interoperability, to offer real-time data, where the current healthcare systems are built on legacy systems. Again, we said they can't talk to each other. How dangerous do you think it is to have tech run healthcare, or do you not think that's dangerous? I guess less friendly than I said, huh?
No. I mean, again, sort of from a very high macro level, I think we're heading towards pretty dystopian times, sadly enough, because we created a parallel universe that doesn't adhere to the same rules that national entities adhere to, and information travels faster than all old school barriers that we erected, yet unfortunately a disenfranchised majority is now voting for, much more nationalism that even prohibits having perhaps global agreements around this information. So yeah, I'm a bit worried about that. I do think that when companies offer services perhaps for free or for a discount, the old adage of if you don't pay for the product, you are the product holds very, very, very true. So yeah, you're gonna probably be mined, and we are all products at this point that are mined. I mean, you and I using Google, WhatsApp, whatever. So the business model of these entities that you're describing is not to make you better. It is to make sure that their revenue is increased, which is usually done by advertisement, right? So it probably will end up in a situation where they are owning the patient channel, if this were the case, and then essentially selling you to the highest bidder. So you have rheumatoid arthritis, maybe you now get Humira, where you're a non-responder to TNF alpha. Good luck. That's not fun. So I do think that it is a risk. I don't think the risk is that tangible yet. It might be in the future, but I don't think it's there yet. And the reason for that is, especially in Europe, we're quite protected by regulation, and a lot of skepticism in the healthcare system. But that might change over time. Yeah.
And do you recommend to your portfolio companies that they leverage things like the Horizon Project? What's your opinion on?
Sure.
Okay.
For sure. Yeah.
So just yes and no.
Yeah.
Yeah, just go do it, right? It's non-dilutive. Please go get a grant.
Exactly.
But I mean, how is this how we counter and build things in Europe that are financed by Europe, built in Europe, stay in Europe? Is that part of the answer, or?
Yes and no. And look, I think there's going to be a very interesting time ahead, right? I mean, we're describing all these technologies from a bottom-up perspective. So, disruption enabled by technological advances. That's one thing. But what is all this without a purpose? And I think the purpose is very clear if you look at what the UN is describing by 2050. 10 billion people on the planet, 75% live in urban environment, creating or generating 75% of the world's waste and consuming 75% of the world's resources. We need 50% more land to feed the population. Climate change. So all these different things are requiring us to rethink the way that we produce goods, the way that we deliver goods, but also the way that we deliver healthcare, because the amount of over 65-year-olds is set to double and even triple in the Western world. Now, what does that mean? If you think of a for Europe by Europe, I just think there's going to be a larger market as a whole. For Europe by Europe, so to say, will definitely increase given some of these macro political changes that we're seeing. And we're still one of the leaders in science and engineering, especially in the generation of talent and the generation of patents. If you look at the amount of high impact paper patents published by European universities, we're number one in the world. So I think it's not only a possibility or a market opportunity, I think it's even an obligation to do that.
And again, let's bring this a little bit back to so what does this mean for companies that are developing new products? Where should they be focusing, or again, maybe re-emphasize, what are the areas that you think are really hot? You talked about some sustainability around the urban area, but where do you see opportunities in the near future?
So in the near future, healthcare technology is hot, right? And especially there's solutions out there that, for example, through very simple assays can understand whether you are a responder or a non-responder to drugs. Those are relatively low-hanging fruits. Like, imagine this: you go to a doctor, you're diagnosed with a complex disease like multiple sclerosis, and the doctor draws your blood, sequences your blood, and then knows which drug you should take and which one you shouldn't. It seems like something that we discussed 10 years ago, but it still isn't commonplace. It's simple things like that in the near future that I think are very, very helpful, because the time right now, because of the cost dialogue, is the right time. For the midterm, what we have let's say quite a strong thesis on is the ability for technology to really enable new biomarkers and to induce new effects. I think a prime example is an investment we made at M Ventures called Akili. Akili basically targets the prefrontal cortex and increases the ability for individuals with attention and hyperactivity deficit disorder to increase their cognition, to increase the way that they spend their time focused on something. And that's really helpful for elderly people, for young people, because cognition is a common denominator in a lot of things. There has not been a single therapeutic in the world that we have the ability to quantifiably improve the cognitive abilities of individuals. And this is like, you know, we're essentially inducing neuroplasticity with that company and creating novel or increasing activity in the prefrontal cortex. That kind of stuff excites me because that's never been done before, and technology is an enabler for that. So novel biomarkers, novel modalities, and indeed the increased specificity of prescription drugs.
So that's very exciting and very cutting edge. How do you sell that back to your investing committee? Because it is still very high risk, right? So I'm guessing that's a harder sell back to the investing committee to do that kind of deal.
Well, we invested in 2016 at the time when I think it was, everybody was like, wait, what are you guys doing? See, this all comes down to data. Taking Akili as an example, they had foundational research by Adam Ghazali, who's a researcher in California, which was published on the cover of Nature. And it was basically a piece of research in healthy elderly adults and improving their cognitive ability after playing a predecessor game of which Akili is now developing for a month. So there are 3 cohorts there, the one with multitasking, one with single tasking, one with, let's say, placebo. And the robust effect of the multitasking group and the neuroplasticity that it induced, and basically a robust effect 6 months later without any further boosting sessions, that was the cohort data and let's say the scientific and clinical data that we needed to say, okay, there's something here, and therefore the risk versus reward for us tips favorably towards the reward. So
the evidence was there, and that's what allowed you to sell that.
Yeah, and I think bringing it back to a lot of the health tech plays, there's 2 types of evidence that we need to see. Either it's clinical evidence that showcases that something is there, because that's the only way to really at some point generate revenues, or there has to be some sense of repeat business, which we then can use as a proxy by saying, okay, there might not be clinical evidence that your solution is working, but your sales suggest that people keep buying it, so there must be something there. And then we can try and work on that side to see what is the signal we can isolate.
And when you're looking at investments, how important is the exit strategy? Because it's years away, but obviously, that's, the holy, that's how you ultimately get paid. So, do you need to see a clear exit strategy, or are you okay with the technology and we'll get to that when we need to? What's the approach?
Yeah, I'll probably, I don't know, I might be vilified by my peers in the industry on this answer, but I kind of believe that, exactly. I kind of believe that if you just, for us, we like to back companies that matter, quote unquote. So do things that really makes a change. Now, if therefore the companies do their job well and they generate their revenues, and ultimately, of course, their margins are looking correctly, and then perhaps even a profit comes out of the company at some point, that really should be then sufficient to either go itself the whole way, which is IPO and basically grow standalone, or ultimately be acquired. So an exit strategy in the early days, I kind of, especially if it comes down to M&A, I sometimes look at it and I'm like, well, why? I have to make an important distinction, by the way, sorry, because therapeutics are a completely different asset class than what I'm describing right now. Therapeutics is value creation along a regulatory framework, and usually there's only one exit strategy, which is an M&A, usually. Whereas on the side where we look at, which usually comes down to revenue generation, margin optimization, and ultimately profit generation, then you're you're really looking at going at it alone. If going at it alone, let's say, is not viable, or perhaps there's a viable takeout offer along the way by either a private equity house or a strategic buyer, that's great. But optimizing for that right from the start by design kind of detracts from the purpose of it, because if you're really building stuff that matters, then why should you be necessarily aiming to sell it right away?
And that would suggest that you are in it for the longer haul. I mean, that's a longer time frame, right?
Well, I mean, yes and no. Like we at Amadeus with the fund that I'm responsible for with my partner Andrea, or going to be responsible for, we're still in the process of raising. It is somewhat later stage that will invest. For early stage investors, that's definitely the case. They'll be in it for the longer haul. And what I was doing at M Ventures, we were in it for like 8 to 12 years to let these things materialize. But then again, I mean, it comes down to what is true value creation, right? Are you looking to sell just for a small uptick in 3 years, which could be a good deal, or are you looking to truly make a difference and wait for that to materialize? I think it comes down on a deal by deal basis, but the initial investment for us is always made with the idea that this is a true game-changing firm.
So I usually wrap up with one last question that I pretty much ask everybody. It's not hard, it's okay. But I'm guessing you've seen a lot of pitches over the years, right? So
I think so, yeah.
Yeah, so what's the one thing that you say, oh, I can't believe they still do that when they pitch? What would you eliminate when in the standard pitch?
Oh God. 4:3 aspect ratio of slides. It just makes my eyeballs bleed. But that as an aside. Yeah, I don't know, companies setting their own valuation. I find that terribly annoying because it's usually just a matter of discussion.
And I'm guessing that happens by inexperienced entrepreneurs, right?
Yeah, because it's like, okay, so I don't know. There's a double-edged sword there, because I mean, you might be saying something that you truly believe in, but any VC knows, okay, so that's basically, if I offer that, it's going to happen. So any gain I get from that point is good enough. And if it's too high, people are going to look at it and be like, that's idiotic. That can't be the case.
Yeah, I mean, either you're negotiating against yourself or you've just eliminated everybody because of the numbers all over. So, all right, I appreciate that.
Yeah, I think that there was one of my former colleagues, he said about a proper sales pitch, it's like it has to be short enough to excite, but long enough to cover the point. And I think that's a good description.
And then what excites you most about speaking at the Barcelona Health Hub Summit on the 29th of October?
That I get to be in a panel again with my friend Pascal.
Well, there you go. We very much appreciate your time this morning and taking the time to speak with us. Best of luck in this new position and raising your fund. And we're looking forward to some big things from you. And of course, you're going to be speaking a lot on some upcoming virtual conferences. So we'll look forward to that as well. Edward, thank you very much. We appreciate your time.
Fantastic. Thanks, Mike.
Okay, take care.